Welcome to this week's edition of the Lucia Capital Group weekly video. I'm Rick Plum. If you've ever done any investing at all, chances are you know what a stock is. The kind of stock that companies most often issue is called a common stock, and that gives you a share of the company's profits through dividends and hopefully some growth in the price of the stock. You're also usually given voting rights, and so depending on how many shares you own, you may have some ability to exercise control over corporate policy and management issues. But there's another type of stock, one that you may not have heard of, called preferred stock. It looks and acts in many ways like a hybrid form of common stock and bonds, but there are crucial differences. It may be generally less volatile than common stock, but also typically has less potential for appreciation. Preferred stock is designed to give you a fixed, regular dividend payment, unlike the variable dividend payments sometimes offered by common stockholders. The dividend has to be paid to preferred stockholders before the dividend is paid to the common shareholder, and those payments tend to be higher. Of course, that depends on the company's ability to pay as promised, which is never guaranteed. With preferred stocks, you're generally not given voting rights, but you do have what's known as a higher claim to the company's assets. So in the event that a company declares bankruptcy and has to be liquidated, preferred shareholders are paid before common stockholders. Keep in mind, though, that you do have to wait in line behind those who are owed taxes and wages and after secured and unsecured bondholders have been made whole. Holding preferred stock does not guarantee the safety of your principal, so make sure you've considered your risk tolerance before you invest. As I said, preferred stocks are sometimes referred to as hybrid securities because they have elements of both common stocks and bonds. They're often issued by banks, utilities, and REITs, among others, and they tend to behave more like fixed income securities than common stocks. So even though they're issued in shares like common stock through an initial public offering, they typically trade at a relatively stable price. Most often we see them issued at a par value of $25, and unless they miss or cut a dividend, they may only go up by $1 or $2 during their lifetime. The interest or dividend income is usually paid on a quarterly or semi-annual basis, and this income is often what makes them attractive to investors. Preferred shares also resemble bonds in some respects as their prices tend to rise and fall inversely with interest rates. These are just a few of the basic characteristics of preferred stocks. Some preferred shares also come with additional features that may make them more or less attractive to investors, depending upon the current interest rate environment. The question for you is this: are preferred stocks suitable for you and your goals? That's an important question, and your advisor can help you navigate through this path. I'll talk about that next week and give you some idea of how preferred stocks may help you mitigate some of the risk in your portfolio.